Reputational risk and how to manage reputational risks. Welcome to the Risk Management of Everything channel. On this channel, you will see videos on risk management and the application of risk management to diverse areas and sectors. If you are new here, make sure to subscribe to our channel and press the notification button so you can be notified when we upload new videos. Thank you. This video discusses reputational risk and how to manage reputational risks. In this video, you will understand the meaning of reputational risk, sources of reputational risks, types and causes of reputational risks, determinants of reputational risk, reputational damage, reputation risk management process, how to manage reputational risks, reputational risk insurance policies, how reputational risk insurance works, who needs reputational risk insurance, challenges of purchasing reputational risk insurance, and reputation risk management during crises. Now, let us start. What is reputational risk? Reputational risk is the potential for negative publicity, public perception, or uncontrollable events to negatively impact a company's reputation, thereby affecting its revenue. Reputational risk strikes without warning. It shifts a firm's landscape, impacts revenue, and causes chaos. Even worse, it affects customer opinions and organic traffic by weaving harmful content into search results. Every organization is exposed to reputational risks regardless of its size, structure, and nature of operations. All risks are significant directly or indirectly, but resulting reputation damage may be more severe, as a reputation is one of a company's most significant assets. Sometimes, it takes a negative rumor to make the public lose confidence in an organization, negatively impacting its reputation. As Warren Buffett said, it takes 20 years to build a reputation, and 5 minutes to ruin it. Reputational risk is the risk that negative publicity regarding an institution's business practices will lead to a loss of revenue or increased litigation. An institution's reputation, particularly the trust placed in the organization by its customers, may be irrevocably blemished due to perceived or actual breaches in its ability to conduct business ethically, securely, and responsibly. For example, companies publicly condemned for their poor environmental policies or high greenhouse gas emissions might eventually suffer a blow to their reputation. A tarnished brand can negatively influence voters who sit in judgment in court cases, community decision makers on corporate expansion and new construction, reporters who cover a corporation's business activities, potential customers, environmental activists who may protest a company's operations, and investors. A fire in a manufacturing facility can result in property damage, employee injuries, and loss of revenues. If operations cannot be quickly resumed or outsourced, customers will lose confidence in the availability of products and go elsewhere. If a popular restaurant is publicly exposed to discriminatory hiring practices, attracting new staff and customers would be difficult. Hence, the restaurant must repair its reputation or risk going out of business. For example, United Airlines received massive negative publicity in 2017 for forcibly dragging a man off an airplane that they had overbooked. A video of the incident quickly went viral, causing many travelers to voice their outrage and even boycott the airline. While overbooking flights is a common practice for many airlines, their treatment of the passenger and their failure to immediately correct the situation caused many people not to trust United Airlines and choose to fly with other companies. Unfortunately, reputational risk is often neglected or confused with other types of corporate and business risks. Let us examine the interrelationship of reputation risk, risk management and strategic risk. Enterprise risk management is the process of minimizing costs and damage to strategic risk. Board directors understand strategic risk because it is specific, measurable, and predictable. Hence, it is controllable. Reputation risk, on the other hand, is largely unpredictable. Opinions of clients, investors, business partners, and the public can significantly impact the firm's revenue. It can even be associated with events that are not the company's fault. Hence, it is essential to be aware of potential hazards that may cause business reputation damage. Sources of reputational risks. The reputational risk appears when organizations fail to act ethically, fulfill their duties, and satisfy their customers. There are many situations and circumstances that could negatively impact an entity's reputation. Here are some potential sources of reputational risk. 1. Misleading investors and the public. Organizations that intentionally mislead investors and the public with false claims of product success and capabilities or falsified financial reports risk severe damage to their reputation. 2. Poor working conditions. An organization's reputation is affected by how its current and former employees reflect on their experiences at work. Suppose an organization offers unfair working conditions and a toxic culture, subjects employees to discrimination, or deals with employee concerns in an unethical way. In that case, it may garner a poor reputation as an employer. 3. Poor quality. An organization that delivers poorly performing products and services will lose its reputation as many unhappy customers share their experiences. 4. Corruption. Corruption and ethical violations are a significant source of reputational risk. A corruption scandal involving bribery, embezzlement, or antitrust violations could significantly negatively impact a firm's reputation. 5. Inadequate data security and privacy. Data breaches are a significant source of reputational risk. Organizations whose customer hackers steal data experience significant reputational damage as consumers lose confidence in their competency to safeguard sensitive data. 6. Poor regulatory compliance. Poor regulatory compliance is a source of reputational risk. An organization with poor compliance could be publicly investigated, convicted of crimes, and forced to pay hefty fines, all of which negatively impact the brand's perception in the marketplace. Types and causes of reputational risks. There are different risks to guard against, including outside adverse events, workplace practices, data retention failures, product recalls, wrong financial statements, and CEO reputation issues. Here are 6 potential causes of reputational risks. 1. CEOs, company leadership and employees. If the CEO has a negative reputation, so does the company. Moreover, that ultimately affects revenue, investments, and shareholder value. That is because a CEO's reputation cannot be separated from that of the company, and vice versa. Company leaders are not the sole source of reputational risk. Any employees could also spark public outrage. 2. Negative articles and publications. Company layoffs, lawsuits, scandals, and regulatory penalties can impact revenue for years if the company do not remove those articles and publications from the Google search results. Whether caused by unsettled employee disputes, customer complaints, or regulation violations, negative media attention can reduce profits for global banks, financial services companies, and other businesses. 3. Social media. Social media can be both a cause and a catalyst for a negative reputation. When company leaders post controversial comments online, their statements affect the entire business, not just the executive's reputation. Unsolicited brand mentions by influential political figures or celebrities can also lead to a social media backlash. Although the company may have been casually mentioned, the public would likely infer a reciprocal endorsement. Social networks can also amplify negative press that may otherwise have gone unnoticed. 4. Services and pricing. Whatever the business models, it will eventually develop a bad reputation if it underperforms or overcharges. For example, a journalist may publish an expose about shady sales techniques or reveal hidden fees. Alternatively, a financial analyst could write a damaging article about the quality of its investment funds. 5. Data loss. Customers entrust the company with their data. Finance companies handle some of the most sensitive personal information, including names, social security numbers, passwords, logins, PINs, and bank account numbers. A data breach will corrode the firm's reputation and result in a reduction in turnover. 6. Regulation changes. Government regulations can change with each election cycle. Businesses are expected to comply with government regulations. Failure to comply with regulations may result in reputational risk. When the public knows that a company does not comply with regulations, they may avoid patronizing it. Now, let us talk about reputational damage. Determinants of reputational risk. There are three major determinants of reputational risk. 1. Reputation reality gap. Reputational risks will increase when an organization's reputation exceeds its actual character. 2. Changing beliefs and expectations. Shifting the expectations and beliefs of stakeholders can widen or narrow a firm's reputation gap. 3. Quality of internal coordination. Poor coordination of decision-making between business units and functions increases reputational risks. Reputational damage. A business reputation is the most valuable asset, especially if it is a bank or financial institution. A negative corporate reputation harms client and investor trust, erodes the company's customer base and hinders sales. A poor reputation also correlates with increased costs for hiring and retention, which degrades operating margins and prevents higher returns. Business reputation damage can also increase liquidity risk, which impacts stock price and ultimately slashes market capitalization. Reputation risk management process. It is essential to develop a framework for managing reputational risk before an issue. The following steps will assist businesses to measure, monitor, manage and mitigate damage to their reputation. 1. Measuring reputational risk. The first step in managing reputation risk is to execute a reputational risk assessment to establish the baseline for the company's image. This will help the company determine public perception of the company and competitors and the industry it operates. Reputational risk is highly subjective, hence it is good to segment the stakeholders into separate groups to determine exposure areas. The company might consider including regulators, analysts, investors, clients, and employees. Next, the level of danger for each segment should be ascertained and take inventory of each group's perception of the company. This can be accomplished through internal and external surveys or search engines. 2. Managing reputational risk. The company can use the assessment as a framework to develop a reputational risk management plan. It might also be necessary to create more than one process and strategy depending on the company exposure. For example, racial discrimination accusations require a different approach than customer complaints or inappropriate CEO comments on social media. It is impossible to offer specific recommendations for this step because there are several possibilities. 3. Mitigation of reputational risk. Once the situation is under control, the company needs to mitigate the damage to its brand through online reputation management. That process involves syncing the company's online presence with its real-world accomplishments. Business organizations may also consider running marketing campaigns to shift the negative narrative and repair reputation damage. Use those campaigns to promote the company's corporate social responsibility programs. 4. Monitor the company's reputation. The final step in a reputational risk management program is to diligently track brand perception against the baseline. Employees, customers, vendors, shareholders, analysts, and activists' opinions should be monitored. Now, let us examine ways of preventing and responding to reputational risks. How to manage reputational risks. There are several vital steps in preventing and responding to reputational risks. Here are 6 ways of managing reputational risks. 1. Make reputational risk part of the company's strategy and planning. It is essential to recognize the impact of reputation on success. Investigate weaknesses and determine relevant reputational attributes within the organization. Brainstorm potential scenarios that could damage public perception with employees at various levels, as they may have unique contributions. Determine indicators and warnings for each attribute to know when to act. For example, customer complaints about the cleanliness of a restaurant indicate that standards need to improve before the place becomes known as an unsafe place to eat. 2. Control processes. standardization, technology, policies, and procedures reduce the likelihood and severity of events that could cause reputational damage. Focusing on consistently supplying quality products and services is much less likely to be a harmful mistake. If something does happen, the company can reduce the extent of reputational damage by explaining established measures to prevent the incident and how to prevent it from happening again. The company should carefully select third parties to work with and treat employees fairly to avoid scandals externally. 3. Understand that all the firm's actions can affect public perception. The board and top management must recognize the importance of reputational risk management, and middle managers must lead by example to promote positive messages to key stakeholders. Organizational training, policies, and procedures can ensure that all employees behave and respond appropriately to any situation. When reputation is at risk, employees must act quickly and responsibly while doing anything within their power to influence public ideas positively. 4. Understand stakeholder expectations. Meeting them is much easier when the company knows what client expectations are. Expectations should not be too high by promising offers that are unrealistic and unreasonable. Find out what customers, shareholders, and employees expect from the organization and management, and strive to satisfy these conditions. 5. Focus on a positive image and communication. It is vital to consistently send out positive communications in all situations. Over time, this will build the company's reputation in the public mind and reduce the impact of future damages. Always inform clients and employees what is happening and how the company responds to incidents internally and externally. Customer service, transparency, good governance, and steady growth are some of the most important messages to convey. The company cannot always please everyone, it should first focus on satisfying the most critical stakeholders. 6. Create response and contingency plans. The organization must respond quickly and appropriately if the worst happens. Every minute can be crucial and reduce the public's respect for the organization and its managers. While seriously underestimated in some organizations, the risk that reputation presents are serious. It is a potential side effect of any risk that can occur, so it is crucial to monitor it. Without effective reputation management, it may take an organization long to recover from an otherwise minor incident. 7. Purchase reputational risk insurance policies to cover the organization's reputation risk. Let us now discuss reputational insurance and how reputational risk insurance works. Reputational risk insurance policies. Unfortunately, reputational risks are myriad, encompassing failure to meet customer needs, product recalls, technology breakdowns, cyber attacks, negative news reporting, and damage to premises or property, among many others. Any of these events could significantly dent corporate reputation for a considerable period. When a reputation is diminished, it can cost the organization customers, profit, and even its ability to do business. Being able to guard against this is an appealing prospect, and the advent of reputational risk insurance has been a welcome fillip for companies with fragile public profiles. Reputational risk is a massive expense that squeezes the bottom line. What is worse, it may even go undetected for years. Because it poses such a substantial threat, firms weigh the benefit of taking out a reputational risk insurance policy. Although insurance can help pay for the cost of a damaged brand image, but it will not address the underlying issue. Therefore, is the cost worth it? Rather than wasting capital on reputation risk insurance, the company should consider strengthening its online presence instead. As you can see, reputational risk is essential to businesses to ensure a good reputation and increased customers' patronage. Reputational risks rank among the top 10 global business risks. A faulty component, a hacker attack, misconduct, the consequences of events that damage a company's reputation can be devastating. Moreover, it can happen to any company, from car makers to food manufacturers to airlines. However, as with life insurance, the issue lies in defining monetary value. How can something as abstract and intangible as reputational risk be accurately quantified? The good news is that reputational damage is quantifiable, which in turn makes it insurable. Insurance covering reputational damage generally covers the company's loss of profits and offers financial support for crisis management and efforts to restore its image. The policy provides indemnification for foregone forecast sales growth, giving a company more certainty for its planning. The insurer verifies the sales forecasts by comparing them with performance to date. Reputational damage resulting from cost savings leading to lower quality, fraud or other intentional acts is, of course, not covered. How reputational risk insurance works. Reputation insurance may be a clause bundled into a broader policy, such as a business owner's liability insurance. This will likely be minimal and focused on incidences of libel, slander, or false advertising. Alternatively, it might form part of a cyber threat policy, covering the consequences of a cyber breach, such as including sensitive customer data being disseminated. Meanwhile, although relatively embryonic in development, standalone reputation insurance has become increasingly relevant to large organizations. Its value lies in covering the cost of lost income due to a damaged brand. The high premium of reputational insurance policies reflects how severe reputational losses might be. One needs reputational risk insurance. With the increasing risk of companies' reputational damage incidents, it is important to weigh whether insuring a reputational risk is worth the premium payable and associated costs. Reputational risk insurance should be a consideration for 1. Businesses with high-value brands are vulnerable to damage by shifts in public perception. 2. Companies within industries whose operations expose them to high reputational risk. 3. Organizations with sensitive data caches are likely to be targeted by cybercriminals or have suffered breaches in the past. 4. Any business for which the cost of a damaged reputation is greater than that of the insurance premiums. Challenges of purchasing reputational risk insurance. The challenge for the industry remains one of quantification. At what point is reputational risk confirmed to have occurred? How long before a payout is approved? At what point can it be said that normality has resumed? Existing methods typically rely on negative media cuttings, gut assessment, and movements in share price. None of these is satisfactory, and all contain the risk of disputes between insurer and insured over when a reputational risk policy clause should be triggered. For this type of insurance to be worth the cost, a series of advanced analytical techniques combined with experienced analysts are needed to create a robust measurement framework that will satisfy all parties. A mutually agreed and sound reputational risk quantification framework is the foundation of reputational risk insurance. An organization can work with insurance specialists and public relations teams to create sensible policies to indemnify the company against reputational damage. Such framework requires 1. The auditing and registering of pre-existing company and sector reputational risks. 2. The quantification of their historical and normative impact levels. 3. Agreed reputational risk thresholds that determine an initial risk alert before triggering a policy occurs. 4. Real-time measurement and alerts on the status of new risks to enable companies to ward off potential threats. Lastly, let us consider steps businesses can take in managing their reputation during crises. Reputation risk management during crises. Controlling public perception is always important, but it is crucial in a crisis. Managing public perception will prevent a simple mistake from becoming catastrophic when something goes wrong in an organization. Critical sectors for crisis management include ethics, quality, safety, security, and risk management. To ensure that the organization is ready for any crisis, here are 5 steps for managing reputation in a crisis. 1. Prepare in advance. In a crisis, every moment can cause severe damage to the organization and its reputation. Hence, it is essential to have plans and strategies before something happens. Continuously monitor any potential crisis factors and recognize when a situation is about to become more serious. Formalize and practice the crisis response regularly to ensure the organization is ready for any event. This step will reduce reputational harm, penalties, and recovery time. It is necessary to emphasize that crisis may not be over when you think it is. Even after the initial situation has been resolved, the organization must handle legal, financial, and insurance issues. 2. Have a working crisis team. A crucial part of preparation is assigning a crisis team to any likely scenarios. This team must be flexible and adaptive, trained, and ready to respond immediately to the situation. They should communicate effectively with both internal and external stakeholders and inspire confidence in the organization. The team should consist of top management individuals whom the public may view as responsible for the incident. Often, it is appropriate to appoint the face of the organization. If necessary, delegate one person from this team to be the head spokesperson for the organization in times of crisis. Pre-approved statements from the company's lawyer or legal team are beneficial, as they allow the response team to communicate almost instantly. The company's staff should be instructed to refer questions to the crisis team to prevent confusion or misinformation. 3. Focus on a practical and quick recovery. Quick recovery is the most critical aspect of crisis management. The company must contain and limit the damage as much as possible. Until the organization has resolved the issue, it is impossible to focus on customer reassurance, rebuilding relationships, and resuming normal operations. The ease of responding and recovering from the crisis will go a long way in saving the company's reputation. The crisis is bad enough. The company should avoid being seen as an organization that cannot control and respond to a dangerous situation. 4. Use the crisis as a learning opportunity. Once the situation is resolved and has fully passed, the company should use it to prevent a similar incident from happening again. Data analysis can give insight into what caused the failure and mitigation techniques to prevent it from reoccurring. The company's spokesperson should explain what went wrong and how it will handle it, thereby re-inspiring confidence in the organization. If the company can effectively manage a crisis, it would survive the turbulent time and come back stronger than ever. 5. Use social media appropriately. An event can go viral in moments in today's environment. Control rumors by directing the public to the organization's official comments on every platform. Do not waste time trying to target individuals. A simple acknowledgement of the situation and what is being done about it is helpful during a crisis. Conclusion. Reputational risk and how to manage reputational risks have been discussed in this video. Reputational risk is that some adverse circumstances could negatively impact an organization's brand, reputation, and image. An organization's reputation and brand equity are intangible assets with an accurate value. They are part of the firm's marketability that should be preserved to ensure its long-term viability. Damage to a company's reputation can result in reduced revenues, failure to meet key business objectives, loss of market share, reduced shareholder value, and in some cases, financial insolvency or bankruptcy. Failure to prepare for negative situations is detrimental to business growth and performance. I hope the video is educative and beneficial to you. Which aspect of the reputational risk management discussed in this video do you consider to be most important? Please post your response below in the comments section. If this video has been educative and beneficial to you, then, give it a thumbs up and share it with your friends. Thank you for seeing the Risk Management of Everything videos. We love to hear from you. Please post your comments and questions in the comment section down below. If you are new here, make sure to subscribe to our channel, Risk Management of Everything channel, and press the notification button so you can be notified when we upload new videos. Thank you.